Hi there, this tutorial is about how we look at finding a strategy that we might be interested in terms of tracking it forward. So you can see here I've just chosen the Petrotsky neglected stock strategy. I won't go into the criteria here, but you can see when we review the results that the strategy itself has periods of over, and in this case here, underperformance of the market, but overall, over a 15-year period, it has substantially outperformed the ASX. Now, to get into the details, you can have a look at the type of volatility that this particular strategy has got. You can see it is actually more than the overall market, so at times you can expect to lose more than the market. And then you can look at the returns and basically decide whether or not this type of volatility and return profile is meets your criteria for your particular strategy when you invest in the markets. Digging into the detail a bit further, you can see there are some periods of quite severe drops, particularly in 2008. So during this time, you may be wondering if it's worthwhile overall to hold on to this particular strategy or to hold the stocks that are in your portfolio which would be losing money at that time. Now, to get a sense of whether this strategy is robust or not, you can see here the kinds of companies which have driven the returns, and you can also note that it's actually not hugely driven by one or two massive outperforming companies. There's some reasonably good consistent companies that have returned good results here, and not too many companies which have lost money. And then further down you can see what the position size allocation is in the portfolio when it's finished, and what the unrealized gains and losses are. So what I'd do next is to run a crash test. So you can just go into the criteria and change the date. And I've done that here, and I've started the strategy in January 2008 and ended it in February 2009. So this tests the strategy over the GFC, and you can see it's bought 20 or it's made 20 trades and lost 23%. Interestingly, it's actually outperformed the market during that period of time, which we may not have expected. The next thing I would do is consider the timing risk of this strategy, because what this strategy does is buys stocks that fit the criteria all on that particular day when you started that strategy. So you may find that it has too much timing risk. So the way to test that is by implementing a step criteria where the strategy can only buy, in this case it's only 3 stocks per month based on the criteria of the strategy. And you can see by implementing this step criteria that it's actually performing better than just jumping in and buying all the stocks at that point in time. Again, you can run a crash test on the step strategy and it loses around about the same as the other strategy, but still outperforms the market during that down period. So that's how I would run through and build a strategy to test it in terms of its robustness, and then once you're happy with the strategy, you can link it to your portfolio and then track it forward. From there, you'll find the individual stocks will come into your portfolio based on the criteria of that strategy, and then you can either do more in-depth research onto those particular companies or automate the strategy. But overall, you will know that you can expect this sort of risk and return profile based on the historic performance of this particular strategy.